Hi, Greg Dorsey here. It's Tuesday, July 6th at Leeb.com, Leeb.com. Hopefully you're staying cool today. Temperatures here in the Manhattan are in the triple digits as they are across much of the country. One thing that is keeping cool is the stock market. Heading into today's trading, stocks were down about 16% from their highs. So it would make sense that we'd have some sort of a bounce here. Bullish investors are certainly pinning their hopes for one, largely on the idea that stocks as a whole are only trading at 12 times forward earnings. Of course, those profit estimates are based on the idea that the economy will continue will come on strongly, something that isn't supported by the recent data. From a technical perspective, we've taken out important support in the 1040 area on the S&P, paving the way for even more declines. True, the market has been known to slightly undercut previous support only to rally strongly thereafter. And you could argue that when the crowd is all on one side of a trade, contrarians generally know to look for a reversal. But looking at numerous sentiment indicators, we can't help but see room for considerably more pessimism to develop. The S&P 500 Volatility Index, the VIX, which is used as a gauge of investor fear, is trading around 30 right now. While that's up substantially from the high teen readings we saw in January, it's still 25% below where it stood in May, and still well below levels that typically mark important turning points. Likewise, among professional and individual investors, call option buying is still running well ahead of put buying. So in other words, there's still a great deal of complacency among investors, both professional and individuals alike. One of the formerly positive market internals that we've been monitoring closely is the relative strength of small cap stocks. And that's been really strong here for quite some time. And that's encouraging, something you want to see. When small caps are leading the blue chips, it suggests that the economy isn't as bad off as many might believe, and that the stock market declines tend to be short and shallow in nature. Unfortunately, during the last few weeks, the small caps have surrendered much of their positive relative strength. Today, for instance, small caps, and we're using the unweighted average of all stocks on the New York Stock Exchange for our benchmark, treats all stocks equally, so it's a really good measure of broad market participation. Well, today it was down 0.4% when the S&P was up about 0.5%, so a pretty wide divergence. At best, the relative strength of small caps right now can only be considered neutral for the market. Another generally bullish occurrence for stocks is falling long-term interest rates. Falling rates make stocks more attractive. However, rather than being a positive for the market, the recent sharp decline in interest rates really points to rising deflationary pressures, in which case stocks trading at 12 times forward earnings isn't that good a deal. So while we may get a modest rally for a week or two, the trend is still decidedly bearish. At the very least, the S&P is likely to test and undercut the 1,000 mark. And absent an improvement in the economic picture, we could be heading much lower. So anyway, that's it for now. Stay cool, and we'll see you again soon.